Take a standard corporate balance sheet. Systems like IFRS are optimized for entities generating profit through voluntary exchange, but a government doesn't operate to maximize shareholder return. Its primary motive is service delivery, and its primary obligation is public accountability. This shift in motive changes the economic physics of the entity. Public sector resources are raised primarily through coercive, non-exchange transactions. When you pay taxes, you are fulfilling a legal mandate rather than making a voluntary purchase, and the value of services received is not mathematically tied to the amount you paid. The nature of assets changes as well. Governments hold roads, bridges, and military equipment for their service potential. These assets are not held to generate direct cash flows, but to fulfill a specific civic function. Because the mechanics of both funding and asset management are unique to the state, standard corporate accounting metrics fail to provide an accurate representation of a sovereign entity's financial health. To address this, the International Public Sector Accounting Standards Board, or IPSASB, rebuilt financial reporting from first principles. Their framework moves the focus away from measuring profitability, centering the entire system on the measurement of accountability. This requires a significant expansion of the General Purpose Financial Report, or GPFR. To capture accountability, the IPSASB framework extends the reporting boundary beyond traditional financial statements. Understanding this system requires mapping the structural logic of the IPSASB conceptual framework to see how the mandate of accountability redefines the modern GPFR. Every reporting system is defined by its audience. This map identifies the framework's primary users, those who lack the authority to demand specialized financial reports tailored to their specific needs. It identifies two primary groups. First are service recipients. These are the citizens and residents who depend on the government to use public resources to provide essential services. Second are resource providers. This includes the taxpayers, donors, and lenders who provide the capital that funds those services. Organizations that already have the power to demand specialized data, like internal management, central budget controllers, or audit institutions, are not the primary users of these reports. For these primary users, the main objective of the report is to assess how well the entity has discharged its accountability in managing public resources. This information also serves as an input for decision-making. It allows users to make informed choices about voting preferences, resource allocation, and future funding support. Because these users provide funds involuntarily and expect services rather than financial returns, a simple measure of surplus or deficit is insufficient. It fails to show whether the entity actually achieved the service delivery objectives it was funded to reach. To meet the accountability objective, the IPSASB framework pushes the reporting boundary outward. A compliant GPFR must include data far beyond the core financial statements. It integrates three specific non-financial vectors. Vector 1 is the approved budget. In the public sector, the budget is a legally binding constitutional artifact. It establishes the authority for expenditure, making a direct comparison between actual results and the original budget a requirement for demonstrating legal compliance. Vector 2 tracks service delivery achievements. Financial results only tell half the story. To justify the use of public funds, GPFRs must record non-financial outputs, detailing the volume of services delivered and the cost efficiency of those programs. Vector 3 adds perspective information. Many government programs and commitments are multi-generational. Assessing the impact of today's decisions requires looking years or even decades into the future. This perspective data allows users to evaluate the long-term sustainability of the entity's finances and its capacity to meet future service demands. This makes a fully compliant GPFR a hybrid document, one that integrates financial accounting, operational performance, and forward-looking economic projections into a single tool for accountability. Expanding a report to include non-financial data and future estimates introduces a high degree of subjectivity and uncertainty. To manage this, Chapter 3 of the framework establishes qualitative characteristics. These act as the engineering constraints that keep the expanded data rigorous, specifically through faithful representation and verifiability. Faithful representation requires that information depicts the substance of the economic phenomenon. In the public sector, this is supported by a specific modifier. Prudence is the exercise of caution when making judgments under conditions of uncertainty. This ensures that assets and revenues are not overstated, and liabilities and expenses are not understated. It is a vital check when projecting future tax receipts or long-term pension obligations. But this raises a question of verifiability. How can an observer verify a projection of a future service outcome? The framework addresses this through the concept of indirect verification. While you cannot count a future cash flow today, you can verify the inputs and the methodology. By disclosing the underlying assumptions and models, the entity allows knowledgeable observers to reach a consensus on whether the representation is faithful. Rigor in public sector reporting is achieved through methodological transparency, ensuring that even subjective estimates are grounded in a verifiable process. With the model fully assembled, the cohesion of the system is clear. It starts with the specific needs of service recipients and resource providers, sets the objective of accountability, expands the scope to capture it, and applies qualitative constraints to ensure rigor. The IPSASB conceptual framework is a bespoke architecture designed for the public sector's specific constraints, rather than an adaptation of corporate IFRS standards. It acknowledges that the volume of non-exchange transactions in government requires a fundamental redefinition of the financial report. It recognizes that the legal weight of the budget is the primary mechanism for financial oversight. For preparers and analysts, this framework provides the necessary tools for modern sovereign financial analysis. In the public sector, a pristine balance sheet provides little utility unless it can be mapped directly to civic accountability, legal compliance, and the long-term sustainability of public services.